Start of this month, we had GMFS say that gold, which has gained to records already, may extend its advance as investors seek a haven for their wealth, targeting $1,300 an ounce. Paul Walker, Chief Executive Officer at GFMS, joins us now on the line to run through some of that forecast. Thanks so much for joining us, Paul. Where we've got this fear of a double-dip recession in the global economy offering some support to the gold price for now. Let's start off with your overall view of the global economic picture and where we're headed.
Well, our house view, and thanks for having me on the show, our house view for a long time has been that we're likely to see a double dip, and I think all of the fiscal measures that are being taken in places like the UK and Spain and elsewhere only serve to compound this belief that's going to happen. I think, in terms of how this plays through into a view on gold, the news flow for gold has been uniformly positive for quite some time now, and the stars have aligned very nicely for gold, and it's one of the reasons we're still bullish in the medium term on its prospects. The double dip is one aspect. Mm-hmm. There is still the inflationary hypothesis that's out there. There are a number of factors that are playing into this, and of course, this week we heard about the Saudi Arabians adjusting their reported gold holdings. Whether that's actually a gold purchase or an accounting transaction doesn't really matter. It's just part of a backdrop of very positive investment news flow about gold. Well,
let's hone in on that inflationary hypothesis that you mentioned, using the US as a case in point to actually illustrate how this would be gold supportive. I mean, if this double dip happens, it would mean more stimulus needing to be pumped into the economy, right?
Well, I think this is where you've got a number of what I often describe as contradictory arguments that have supported gold. In a sense, it doesn't really matter. If somebody believes in the double dip and they're buying because of the risk that's going to have in terms of additional fiscal stimulus, growing imbalances, then that's one basis on which to buy gold. On the other side, you've got the inflationary hypothesis, which is you're going to have the monetization of this government debt, and inevitably it's going to have inflationary consequences. Mm-hmm. Some would even argue that the double dip and the inflationary hypothesis are opposite sides of the same coin. So, the interesting and fascinating thing about the gold market at the moment is you've got what I would say are often contradictory reasons for buying gold, but still leading to a positive investment climate for gold. And we think that's going to persist for the foreseeable future, which is indeed why we're calling, $1,300 plus gold.
Well, because of the sheer uncertainty of it all, I mean, gold for now getting nice support, being seen as a good long-term investment. Just how much of a safe haven is gold, though? Because back in May, where we had equities under pressure, we saw somewhat of a selling pressure being put on gold as well. Investors liquidating, their gold positions because they had to repatriate funds. Just how much of a safe haven status is gold holding right now?
Well, I think you raise an interesting question. I mean, people make the safe haven argument for gold, but then when the proverbial does hit the fan, you see this liquidation, you see a move back to the dollar. So, it does raise questions about the universal safe haven appeal of gold. Because if it were just unambiguously the case, you wouldn't have the situation you've just described. Mm-hmm. So I think, what we have to understand here is that the class of investors who are invested in gold at the moment are incredibly disparate. There is often I think something in people's minds that there's a homogenous group of people who are investing in gold. This is absolutely not the case, and our GFMS research shows this very clearly. When you go and visit the private bankers in Geneva or Zurich, they will give you one story about a class of high net worth individuals. There's quite a different class of investors, for example, coming out of the United States. They're all buying for different reasons, but that is manifesting itself in higher gold prices. But, the very issue here is how tightly held is the gold that people have been buying? And you've just raised the point that when we do see this kind of rush to flight to quality concerns, we have actually seen the gold price come down as people have moved back into the dollar, for example. Mm-hmm. So I think, we are at this interesting juncture where the investment flows are what makes gold tick at the moment. It's all about investment. Ask the question, who's going to continue investing in gold? Which class of investor is going to still be there in the long term investing in gold? And I think that's when you start to get into interesting questions about the sustainability of prices at $1,200, $1,300 and possibly higher. Mm-hmm. It's going to be all about the tightness of the holdings of gold and who's willing to be there for the next, not 6 months, but the next 6 years.
Well, with that being the case, and just at this stage, there being a lack of options for many investors at this stage. I mean, low interest rates is one of the things making gold attractive because there's simply no yield anywhere else. When do you see rates, for example, rising and offering some kind of alternative?
Well, I think you've hit the nail on the head here. I mean, I'm an obsessive about real interest rates, and I think the reason we got ourselves into the mess that we're in, macroeconomically speaking, is, amongst other things, interest rates were too low for too long. And, the GFMS house view is that we'll probably see interest rates starting moving up in 2011. My personal view on this is that the credibility of central banks, where the yield curve is going to be moving over the next 6 to 12 months, is going to push interest rates higher, both at the longer end of the yield curve and at the shorter end. Central banks have to reassert their credibility here, and I think they're at an interesting juncture in their kind of credibility cycle that they've really stretched the envelope out. The European Central Bank buying government debt in contrary to the Maastricht agreement. We really are in tricky territory where, to reassert their credibility, there's really only one thing that central banks have, and that's interest rates as a tool.
Yeah.
So I think we're going to start to see a tightening of this cycle sooner rather than later. And this is where gold really starts to enter difficult territory in terms of sustainability. You've seen massive inflows into gold. We estimate probably 4,000 or 5,000 tons into the London market over the last 7 years on a net basis. People are funding that. There's an opportunity cost. That opportunity cost at the moment is very low. Mm-hmm. And your point about interest rates, in my view, when we start to see a material increase in interest rates, that's when it'll focus investors' minds on, is this the best place to be? Is there a yield elsewhere? That's when gold starts to have some difficulties.
Well, certainly interesting times ahead.